and we'll get started. So Birch, I want to introduce you. Birch is a SCORE member and also a State Farm independent owner. I believe that's how you guys do that. I met him at the the North Valley marketing meeting, super informative. So Birch is going to talk to us about what's going on in insurance in the disaster world. So Birch.
Hi, good morning. Thanks for having me here. So I have an office located in San Jose, near Japantown / in my garage. So I know everybody's kind of doing different things, but it's nice to be here today. Listen, talking about a few things in the trenches, some current events that I'm seeing with clients that I have with State Farm, and some things that we're seeing maybe more on a state level that are just starting to happen. One of the issues we're now seeing that those who have been displaced from the fires at this point in time have started really to settle in and find places to stay and alternative living places. And fortunately, if those people who have insurance are going to have coverage, that's going to extend and help pay some additional living expenses. But one of the current issues that's happening right now, once the smoke has started to clear, is homeowners now have to start the daunting task of inventorying their personal property and their losses. And this can be a struggle for a lot of people, especially if you're juggling families and work and living in a new area and needing to get back into a home and replace some of the things that you lost. So as it stands, typically under normal circumstances, if somebody loses a home and their personal property is destroyed, the requirements through your insurance policy in the state of California require that you submit an inventory list of everything that you lost, and then the insurance company is going to replace or send you funds to replace those. Well, with the catastrophe and the volume of people who have a significant number of total losses, this is becoming even more daunting for individuals. Hot off the press is the state of California is asking insurance companies to advance personal property replacement coverage value in the amount of a check on a voluntary basis. And most companies are requiring inventory lists, but as per my conversation internally with State Farm is going to extend 30% of the value of their dwelling to go towards personal property coverage. So insurance companies are trying to do the best they can. Their issues are, when you talk about the number of homes that have total losses, they're on the hook for a significant amount of money and need to inventory and be able to keep track of the funds that they're paying out, so the premiums they're taking in actuarially are accurate. So those are some of the things that are happening, but that doesn't negate the fact that that inventory list is still going to need to be done at some point in time. So that's something that homeowners are going to have to settle into and know that they're going to have to sit down and create that inventory list. The other significant thing that's happening is availability. People not being able to get homeowners insurance in areas that are considered wildfire. That's becoming a significant issue, especially for new buyers going into areas. With more and more people moving into forested areas, and with the forests not being able to naturally be cleaned out due to fires over the past 100+ years, we're starting to see these catastrophes. So there's no simple or easy answer to avoid some of these disasters moving forward unless there's significant effort to start clearing out some of these areas. I think limiting building construction is going to be tough because of the pressures on housing. So homeowners insurance is becoming extremely important, and making sure you have enough insurance to replace the structure of your home is equally important. Specifically in the Bay Area, the San Francisco Bay Area, the cost to rebuild your home is outpacing the insurance rider on your homeowner's insurance policies. So it's very important on an annual basis to make sure that you look at your insurance and you know that you have enough coverage to replace your dwelling based on the cost of construction. Cost of construction is increasing dramatically for lots of different factors, whether it be materials, mostly it's labor, and now it's just the fact that there aren't enough builders out there to build and replace these homes, so you're going to see a lot of inflated prices. Those are the biggest things that we're seeing. I just encourage everybody, as if you have any questions at all, you should be able to get a significant number of answers from your current insurance carrier. If you start asking questions, am I covered for this? What do you recommend? How can we choose this limit? Don't just talk about price. Go into the coverages and make sure those coverages are appropriate for what your exposure is.
Awesome. Thank you, Birch.
You're welcome.
And just, I'll just ask a quick question, and I know it's not the end. Are you guys finding people that you have currently covered are losing their coverage from companies, from all companies, and needing to get state coverage?
More and more, I am seeing that more carriers are restricting where they're going to insure. And that's due to the high exposures. I mean, when you start to lose whole neighborhoods, those become catastrophe, and the cost to rebuild those homes sometimes can be burdensome on some insurance companies. And each insurance company is going to have their own resources to make sure that they handle those catastrophes. So yeah, we're seeing it all over the place. It's not an easy answer. Thank
you. We're going to jump over to Tony Ventura with Ventura, Hersey, and Muller. Tony, if you can kind of tell us what happens if people are in the process of buying and selling, and disclosures when it comes to insurance, and those types of things.
Sure. First off, thank you very much for having me this morning. It's a pleasure to be here. I'd like to start by talking about the types of conditions that could make a home uninsurable or make the insurance more expensive. So the types of things we're talking about are previous fire damage to a home, or previous claims related to fire damage, landslides, or being in a home that's been marked as being in a fire zone or a flood zone, or other conditions such as previous earthquake damage, or things related to the soil erosion, expansive soil, or certain types of clay zones. So all of those different things, if they're marked in, in the natural hazard report, can relate to requiring higher rates of insurance or making a home uninsurable. So the next thing that comes up is, well, if you're in one of those conditions or one of those zones, what is a seller's duty to disclose? Well, generically, the seller must disclose any information that materially affects the value or desirability of the home. And in California, that's an objective standard, which means that it's what the average reasonable person would disclose in your situation. And a lot of times we get into situations where sellers all of a sudden think, well, this may affect what someone's willing to pay. It may affect what I'm going to receive. And in those situations, I would advise sellers to realize that it's better to disclose things up front, because when, from a litigation perspective, what a seller is most likely to be sued for after the close of escrow is a non-disclosure issue. And at that point, it becomes a lot more costly and a lot more detrimental to, kind of your net return on the sale of your home if you end up in litigation. Relative to insurance, the types of things that you need to disclose are, number one, previous claims. There is a specific question in the California Association of Realtors Seller Property Questionnaire about previous claims for insurance. Another type of thing that needs to be disclosed are any previous landslides, soil issues, flood damage, drainage problems, grading problems, or earthquake damage. All of those are specifically called out in the transfer disclosure statement. But what are some of the new things that may need to be disclosed under an objective disclosure standard? I would suggest evacuation orders, or instances where you've been required to evacuate. This past summer, a lot of people have living in homes have been forced to evacuate for 3 days or 7 days or 2 weeks. If that happens, to your home, and then you sell it the next summer, or the summer after that, that's probably something objectively that someone buying your home is going to want to know. Another issue is your inability or difficulty to insure your home. If in the past 2 years, your insurance rates have doubled or tripled or quadrupled for whether it's related to fire or flood or landslides, that's something that a buyer probably wants to know. If a buyer goes in thinking the cost of fire insurance on a tract house, up against the East Foothills is going to be $1,200 a year, and after they close escrow, they find out it's $5,000 a year, and the next year it's $7,500, and you knew that, that's probably something that may be subject to a claim. So what happens if you're a buyer and you learn of one of these things at different points in time? Well, there's three different periods where you could learn this, that you may have a claim. One is if a buyer learns during escrow, but before they've released their contingencies. So the buyer still has a property condition contingency, and they learn that there's an issue where the house is either uninsurable or the cost of insurance is more than what's disclosed to them. If they still have the property condition contingency, then the buyer's remedy is to cancel the contract and receive a return of their deposit, or to try to renegotiate on terms that are more favorable in order to release their contingency. But that's the point of the contingency, is that if you, as a buyer, decide you discover something that you don't want to buy the house, then your remedy is to exercise that contingency and cancel. But that's the easy one. The second time period is what happens if you discover something after you've either released your contingency or you're in contract without a property condition contingency. Then what do you do? Well, then you have two different options. One option is you can assert that this was something that was not disclosed to you by the seller. And when you discover it, that opens up your window for this property condition contingency, and you have either a 3 or 5 day right to cancel, or depending on the timing of it, California law may give you the right to close escrow and then sue after the fact. And that depends upon what your damages are and how you can best mitigate. So for instance, let's say, you discover that you're going to have a flood insurance requirement that wasn't disclosed, and that's going to cost you $3,000 a year. And you discover this 3 days before the close of escrow, but you've already sold $500,000 of stock. And to cancel escrow, you would incur a $300,000 penalty if you canceled. Well, in that situation, to mitigate your damage, it would be better for you to close escrow and have a $3,000 a year problem, as opposed to a $300,000 problem from canceling the sale and eating the penalties on your stock sale. So those are how you compare those damages. And then the third timing is what happens if you discover something after the close of escrow. So for instance, let's say initially when you close, the fire insurance policy is only cost you $2,000, but you discover after that there's either an assessment or a change, and your next year policy is going to be $10,000, and the seller was aware of it because they received a notice, and that notice wasn't disclosed to you. So your initial policy is affordable, but your subsequent policies aren't. And you're staring at the possibility that you're going to spend 20 years in this house, and every year your insurance is going to become more and more unaffordable. And if the seller was aware of that and didn't disclose it, then you maintain that claim after the close of escrow. And I think the best way to describe I know people like to hear from a lawyer cases that are on his or her desk. So I can briefly just give you two examples of cases that have arisen in the last 6 months that we've dealt with here in our office. One related to a fire insurance claim where a seller was selling in the Saratoga area, and the seller during escrow was a non-contingent sale, and the buyer was trying to obtain insurance and found out that the insurance was going to be twice as expensive as disclosed. And so the buyer tried to cancel on the basis that the house was uninsurable, and the seller took the position that, the fact just because the insurance is more expensive than contemplated doesn't make it uninsurable. That's just a cost of doing business. And when you're buying a $4 million house, and the fact that your insurance is, $4,000 instead of $2,000 is pennies on the dollar compared to the sales price. And the buyer ended up canceling, and it was a deposit dispute over whether or not that's a material non-disclosure that justifies a cancellation. And then a second issue was where the buyer was told during escrow that the house is on a floodplain and required flood insurance, but the seller disclosed that you could appeal that and have the house removed from the floodplain by having it resurveyed. And then it turned out that after the fact, after the close of escrow, the buyer applied for that and was denied, and then sued the seller for, for essentially being wrong in that representation. And the seller's response was, well, no, I represented to you that one of our neighbors had that done. I didn't say that it could be done. I just represented to you what I had heard, the neighbor did, and I didn't guarantee it one way or another. And the buyer's suing, saying, hey, I'm going to own this house for 30 years. At $3,600 a year for flood insurance, I'm entitled to $300,000 or $400,000 in damage. So those are the types of litigation that we see just arising from these types of insurance issues.
Very interesting. Now, do you have the outcome to both of those? Because now I'm curious.
The deposit dispute ended up settling at mediation, somewhere in the middle. And the second matter is still pending in litigation.
Interesting. Thank you so much. And now we're going to move on to Marilyn Sparks. Marilyn comes to us from Southern California. She is one of the LA County Insurance Commissioners, and she's also an affiliate member, I believe you said, with Citrus Valley Association of Realtors. So she's very knowledgeable about when it comes to real estate and insurance. And LA has had its own fire and mudslides. That was another one you brought up in the Malibu area. I know that was a big deal. So Marilyn, welcome and thank you for joining us.
Thank you very much. I hope you all can see my screen. So yes, I'm the Los Angeles County Insurance Commissioner. I'm also an agency owner and insurance advisor. So I do see cases on a daily basis and am in the thick of it. We've experienced our share of fires, mudslides, especially after fires, and of course, earthquakes. I wanted to touch on wildfires and give a history. Many may already know this information, but I just want to provide some context as to how we got to where we are today. 2017 was almost 1.4 million acres were burned. 10,000 structures were destroyed or damaged. 47 people lost their lives, 1.3 billion in cleanup, and almost 12 billion in claims. This was higher than the previous 9 years combined. I'll say it again, higher, 1 year, higher than the previous 9 years combined. And then 2018 came along where we saw 1.8 million acres, over 23,000 structures destroyed or damaged, 100 people lost their lives, 3 billion in cleanup, and not all of the claims have been settled. It's almost 12 billion in claims. 2019 was more of a mild year, and I'm not saying that to diminish loss of life, loss of property damage. It just wasn't as large as 2018 and 2017. This year, we are at 4.25 million acres burned. It's about 4% of our entire state has burned this year. Not only have we seen mega fires, but we had our first giga fire, which is one single fire burning 1 million plus in acreage. 92 structures have experienced damage or destruction, 31 deaths, and then cleanup and claims. That number's not yet been determined, but it's going to be costly. Part of the cleanup, we're going to see an increased cost in firefighting because of COVID. COVID has changed the way fires are fought. and that is you're not having big groups of firefighters together in close quarters. They're a little bit more spread out. Part of the forest management has said that they're looking towards a more of the Smoky Bear approach, where even a small fire is extinguished right away. Firefighters are being kept in hotel rooms, again, adding to the cost of what wildfires are doing and how they're damaging our state. Some of the underwriting guidelines these are some of the categories that are looked at when determining if an insurance carrier will offer a policy on a certain property. Brush clearance is obvious and something that in most cases can be easily remedied with clearing brush and debris away from the home. Wildfire tiering, this is from the California Public Utilities Commission, where they have determined which areas are high hazard zones, and tier 2 and 3, which pose fire threats. A fire line score is a score on a scale of 0 to 30. Included in this scoring model is fuel. It identifies whether an area is covered with grass, trees, or dense brush. Slope identifies whether a risk is located on a steep grade. The steeper the slopes can increase the speed and intensity of a wildfire. The slope also affects reconstruction costs. And then access. This identifies whether a risk is on a dead-end road or a dead-end network of roads, and refers to a matrix that takes into account the distance of that road back to the main street network and the predominant fuel type that the road passes through. I mentioned earlier that the score is a 0 to 30. Most carriers are writing a 0 through 3. So anything 4 or above may require looking at a California FAIR plan in conjunction with a companion policy, and but you'll have to check with carriers and see if they're writing or not. SHIA, that identifies the likelihood that a risk outside but immediately adjacent to a high fire fuel area will ignite because of its proximity to high heat and wind-borne burning embers. Embers can travel for up to 1 mile. That's a long way, and I know it's a long way because I don't like to exercise. Legislative. Currently, the California FAIR Plan, the state commissioner, Richard Lara, has asked the California FAIR Plan to expand their writing of policies, meaning to not just have fire as the covered peril, but to actually include other perils. Expand the type of coverage to mirror a traditional homeowner policy. The California FAIR Plan is seeking remedy in the courts that no, we are here to only write fire. We should be a last resort type of plan. If someone cannot get coverage elsewhere, we shouldn't be, we meaning the California FAIR Plan, shouldn't be entering the private insurance market. Someone spoke earlier, Jody may have referenced that sometimes people think the only option is the California FAIR Plan, and it's understood that the California FAIR Plan writes everybody. That's actually not the case. You can be denied by the California FAIR Plan for not having, if you have too much brush nearby or if you have debris near the structure. So you've got to follow their guidelines as well. AB 38 is a bill or a law that takes effect January 1st, 2021, and it would require the seller of any real property located in a high or very high fire hazard severity zone to provide a prescribed disclosure to the buyer if the home was constructed before January 1st, 2020, of information relating to fire hardening improvements on the property, and a list of specified features that may make the home vulnerable to wildfire. Tony spoke to some of those issues earlier. AB 2167 was discussed earlier this year. This would establish an insurance market action plan. It was designed to make homeowners insurance more available in defined high-risk areas of the state. There are many insurance carriers that would love to write higher than that fire line score of 3. The question is being able to charge the rates to go with the risk. And that's what this law was going to do. It had bipartisan support, but it ended up being tabled for 1 year, one legislative year. It was a bit frustrating because in 2019, Governor Newsom had talked about how the need to do more to help homeowners in these areas. And this bill, I personally felt, would address those issues. On Monday, I attended a virtual investigatory hearing on homeowners insurance availability and affordability that was put on by State Commissioner Richard Lara, and talked about, revisited Prop 103, which is several years old, where it protects against unfair rates, and it allows insurance carriers to almost predict the future using history as far as what they think that their claims might be, and how we can mitigate that by charging the right amount of insurance premium. Mitigation is key. We had over, I'm looking at my notes, there were about 24 speakers on availability and affordability. Everyone on the panel, not on the panel, but some of the contributors were fire captains from throughout the state, homeowners that have experienced loss, the cost, how to their homeowners insurance is almost as much as their mortgage payment. And so you have people that can't afford the insurance, so they're selling their homes, which that would be okay, except now you've got a surplus, which is driving down prices. And so the people that can't afford their homes are selling at a reduced price to try and find a house someplace else, and the money that they walked away from that property is not enough to buy something else. So it's putting a lot of pressure on the market, and we need to come up with some answers. Flood insurance is available through the National Flood Insurance Program, which is administered by FEMA. There are private flood programs also available. This is a picture of a home mudslide victim in Southern California several years ago. Homeowners don't understand, we are all in a flood zone. Every single home and business in the state of California is in a flood zone. It just, the risk difference. Flood zone X is the least expensive and the least amount of risk. And there are several categories of risk, but please know every single home is in a flood zone. It's just a matter of which level of degree. Earthquake, like floods, we are all in an earthquake zone, so to speak. There aren't zones, but we could all fall. Our home, our business can be damaged by earthquake. And many of my clients will say, oh, my home has survived the Whittier earthquake or the Napa earthquake. It's not going to happen to me. I kind of give the example of the flu. Flu season is every year. Some years we catch it, some years we don't. Don't think that just because your home has survived this long that it will survive the next quake. We don't know what kind of quake, the rolling, the jolt, what your home is susceptible to. Older homes, kind of like our pre-war homes that are built on raised foundations, can take advantage of the Brace and Bolt grant program. There is earthquake insurance that you can get through the California Earthquake Authority, as well as other companies like GeoVera. There is a assumption that earthquake insurance is very expensive, but prices have really come down in the past couple years, maybe 5 years. As more people participate, the risk is then shared. This is all based on, insurance is based on the law of large numbers. So the more people you have in the market, then it brings down pricing. People are afraid of a large deductible, and you do not have to come up with the money in order to file a claim for earthquake insurance. The deductible is deducted from your claim award or payout. So don't think like, oh my gosh, I've got to come up with 15% of my insurance policy in order to get the repairs or the rebuild done. Some resolutions. Policy review, that was mentioned a couple of times. I recommend an annual review of your policy and the reconstruction cost, coverage A, dwelling coverage. That is the cornerstone of the policy. Everything else, almost everything else on the policy is built on that first number. Do you have enough money to rebuild your home? The national, I'm bringing up this statistic, or I don't know that it's a statistic, but a statement by the National Association of Home Builders says that lumber prices hit a 2-year high, up 50% since April. So again, do you have enough to rebuild your home? That dwelling coverage also includes some of the soft costs. It's not just building materials and labor. It also includes your permits, architectural drawings, blueprints, other things like that. 4 questions that I always have my clients ask themselves. Do I have the right coverage? Do I have the right amount of coverage? Am I getting the best value? And if the worst happens, am I covered? The next thing you can do, home hardening. There are some things that you can do very quickly and inexpensive, in an inexpensive manner. That's cleaning debris. Keep things away from your home or your business. Clean out your rain gutters. Make sure you don't have any dried leaves in there. Make sure your roof is clear of leaves, pine needles, things like that. You can visit sites to help you, give you ideas on what to check on as well. We already talked about flood and earthquake insurance. Again, we're all in a flood zone. We are all in an earthquake zone. And so you want to investigate to see what it would cost to protect your home. The resources, there are several, ready.gov, California Department of Public Health, Governor's OES, and then your county, specific county or local city can also help with information. Shakeout, we just had the great shakeout on the 15th, and then your own insurance agent or broker should also be able to provide you with resources. One of the things that I believe Birch spoke to earlier was about inventory. Don't wait until disaster to sit down and try to recall what is in your home. Do that now and either save it in the cloud or give it to your agent. Don't put it on a flash drive or have pictures on your computer, because if your home burns and your computer's gone, now what? Do it now. Take pictures, each room in the house. And like I said, make that inventory. Your own insurance agent or broker may have a fillable spreadsheet for you to use that you can go through and take the inventory. Do it now. Don't wait for a disaster. And then if you need more information or would like to contact me, here is my contact information. I haven't seen any questions come up, but the number one question that I get is, what's the first thing I should do? And to me, the first thing is have your policy reviewed. Make an appointment with your agent and have that reviewed.
Thank you, Marilyn. And thank you to Birch and Tony. If you have any questions, comments, I see a hand raised. Leanne, if you want to put your question in the chat or the Q&A box, we can't unfortunately unmute you, so you can put your question there. I learned a lot. I'm going to go through and take pictures and inventory what's in my house. Tony and Birch, in listening to what Marilyn was talking about, do you guys have any additional thoughts for anything? Or we're waiting for some questions, because I know she's probably typing. Or Malia, do you have questions?
Oh gosh, I did look up some questions. So I guess going back to, taking pictures of things in your home and preparing before disaster strikes, how do you put a certain value amount on certain, items you have? Just because some of those things can be arbitrary if they're, family pieces that you have or things you don't even remember what the price is.
Well, keeping receipts, number one, is the best. But you speak to family pieces. There are things that are just not replaceable. There's no insurance for sentiment. If you have, I have a client's daughter, she is getting married in 2023 because it will be the centennial of her great-grandparents' wedding, and they're using her great-grandmother's wedding ring. If that's gone, it is gone. We can replace it with a 10-karat gold band with 3 diamond stones, but it's not going to be that ring. So sentiment is a little bit different. I have another client. She has a lot of her furniture is from her homeland. You can't pick that up at Living Spaces, right? So if you lose a dining set, you'll get a dining set. If you have the receipts, that's your best documentation. And that's something that's easily scannable and put into a cloud-based storage as well. I wanted to speak on traditional carriers. If you cannot find coverage, you can always go to the surplus lines market. Surplus lines can do business in California. Their difference is that they don't participate in the Insurance Guarantee Association, meaning if they are unable to pay claims because they're insolvent, that Guarantee Association will not be the backstop on those policies, but that is an option.
Thank you. And we have the question, there's a few questions here, so maybe between Birch and Marilyn. The question is, how does a typical homeowner know how much coverage they should need? how do they know what the cost of replacement is? Are there just algorithms based on what kind of a house, how old it is, square footage? So how do you determine that?
I can take a shot at that.
Yeah.
Sure. So insurance carriers now are required to complete a cost replacement calculator on your homeowner's policy. And these calculators take into consideration the type of construction that your home is built, the amenities, the age, the condition, pardon me. And this calculator is designed to determine the minimum amount the insurance company will insure you for up to almost 100% of the replacement cost. And you want to stay within that 90 to 100% replacement cost insured to value on your policy, so you maintain all of the benefits within the policy. Now, with that being said, calculators are usually developed by third-party vendors, and these calculators sometimes are not always up to speed in regards to accurate replacement costs in certain areas. For example, in the South San Jose and up the peninsula and in San Francisco, these costs are changing monthly, and these calculators cannot keep up to speed. So it's very important for the agent or someone in the industry or somebody that you know has a pulse on the cost of construction based on the type of home that you have. And so I think a good rule of thumb is to take a look at the amenities of your home, the type of construction, and look at the replacement cost and divide that by the square footage. Most builders talk about replacing your home in a square footage ratio, whether it be $250 a square foot, $650 a square foot. It's a lot easier to get your hands around that number and talk about it amongst vendors, contractors. And then at that point in time, your insurance policy should reflect that replacement value. Now, it's always going to be a moving target. Lately, in the last 7 to 8 years in this area, it's been going up because of cost of construction, but it will cycle. There may be some down times as well. Don't see those in the near future, but if you're overinsured, you can always readjust. I think those are the biggest concerns in regards to the homeowner's policy and making sure that you're insured to value. It's just having a good conversation and having awareness of what would it cost to replace your structure.
May I add to that?
Of course.
So excellent points, Birch. The other thing is that insurance value has nothing to do with the market value of your home. Insurance policies do not include the land. It's the box that is your house. That's it, the reconstruction costs. Another thing to look at on a policy is their extended replacement costs, a percentage that would provide a cushion for unexpected spikes in the marketplace. If there's a labor shortage, or if we're getting the drywall from Canada and that supply interruption is happening, tariffs add to the cost, things like that we just can't always foresee. Another point is, when you get your insurance policy, you file it away, but this is truly a living document. If you're making improvements or upgrades on your home, please contact your agent or broker. If you've just put in granite countertops and you got rid of that old Formica, your insurance carrier wants you to get back to granite. You don't want to have the insults to injury of having to go back to Formica because we didn't up your replacement cost value.
Thank you. Couple more questions in here. So there's a question about companies for insurance, earthquake insurance. So can you get that through? I know, honestly, Birch is my insurance agent, and I went to him because he was talking about the cost of insurance, and my own insurance agent had never discussed that with me to make sure that I was insured. So I know that they offer earthquake insurance, but are there third-party earthquake insurance companies as well? Or is it just through your regular insurance company?
Most insurance carriers do not offer their own insurance. It's usually offered through the California Earthquake Authority, Giovera, or other carriers.
There's a question in here about what happens if the California plan runs out of coverage. Will it?
Well, they've got quite a bit of premium and reserves that have to be set aside. They are a quasi-government agency. And so, you know, I don't know what would happen if they ran out of money. I'm hoping that that never happens and that it is being properly managed for fiscal conservative and making sure that reserves are being able to be kept in place.
I've got a question for Anthony and for Tony, and this goes back to we did some webinars earlier in the year, and there's a report that agents can get, but a lot of them either don't anymore or don't even know that it exists, and it has to do with the insurance. And I honestly cannot remember what the name of the report is, but it goes back 7 years and it looks at 7 years worth of insurance, any insurance claims on a house, from broken pipes to, Marilyn, you're shaking your head. Do you remember what that's called?
I don't know the name of the report. I know as an agent, we can see the loss history, and it's such a good point as far as disclosure. We talk about you have to disclose that you're in a fire area. I currently am working with a client who's purchasing a home. That home had a $200,000 plus water claim on the home, and the disclosures are supposed to come out today. I'd like to see if that is included, because the home boasts all new plumbing, all new flooring. But when I go to the city website to check for permits, none were pulled. So that's a whole other can of worms and rabbit hole.
I just Googled it. It's a clue report.
Clue. Yeah.
So getting clue reports and things like that, I think my understanding from the webinars and listening to some of the agents is they're underused, but they're definitely something that is important. Do you see those in litigation type things, Tony?
So the law is that sellers only have to disclose what they know. So if someone hasn't owned the house that long, right, they're discouraged from going back further than they own, because they don't necessarily want to draw up information that is beyond their knowledge, right? So that's a lot of times why agents don't have sellers do them. At the same point in time, it's always a good idea for buyers to ask for them, because, from the buy side, it can get you more information. Right. So from the answer to your question is, from a buyer side, it's always a good idea, and they are underutilized.
Yep. So make note of that. Get a clue report or ask for one. There's a question on here about what resources can we use to get the estimated cost per square foot in the area the home is in. Is there a builder's site or something they can look at, or is just to Birch that you were talking about, is this just a third-party calculator that's used?
You can get an appraisal done on your property, an insurance appraisal for replacement cost. That's an added cost if you want to be accurate. Once again, that cost will be based on that exact time and date. And over time, it will become old and obsolete. I think the best rule of thumb is you want to get it as close as you can, because insurance policies have additional replacement costs built into them, either 20 to 50%. You don't have to have an exact number, but you want to be as close as possible.
And there's one more question in here, and I think I understand it, and you guys may. Does fire insurance or do fire insurance policies cover increases in fees and permits required?
I'll jump in on that a little bit. There is a provision in your policy. It's called Building Ordinance of Law. And if you have to rebuild with a permit and change the construction of the home prior to when the damage was, then policies do carry additional coverage within the policy to pay for those additional expenses. And so the policy is designed to pay costs that you incur due to the loss at that time.
Awesome. I don't
Jody,
see. Yes.
can we go back to the California Fair Plan?
Yes.
Okay, so there is no public funding or taxpayer money involved in the FAIR Plan. The FAIR Plan, according to them, is stronger than any single insurer since it is backed by the capital and surplus of all insurance companies writing property insurance in the state.
Interesting.
And the plan was established under Insurance Code Statute Section 10091 in August 1968.
Interesting. I'd never heard of it until recently. So with
it's increasingly popular.
Yeah. Yeah.
And to I think it was Birch that made the earlier comment about underinsurance. After the fires in 2018, there was quite a revelation of property owners who were underinsured. The wildfires did not cause underinsurance. It only made the situation come to light when people went to rebuild and realized they only had enough insurance to build half of a house. So policy reviews are so important.
Mm-hmm. And there's another question that came in that I don't know if we'll be able to answer, but is it true that at least 800,000 homes have been redlined based on zip codes and wildfire areas? And I'm assuming I'm assuming redlining means that you can't insure them at all anymore, or that the insurance carriers won't insure them.
I don't know if that number is accurate, but there are a number of non-renewals that do go out when homes are assessed based on brush clearance, wildfire tiering, fire line score, or special hazard interface areas. It doesn't mean that the home is uninsurable. It is that carrier is unable to write that home and that the homeowner would have to seek coverage elsewhere.
I think each carrier has their own underwriting guidelines.
Correct.
Yep.
Okay. Those are all the questions. Tony, Birch, Marilyn, do you have any closing thoughts for everyone before we wrap up? Tony, I'll start with you if you have anything.
My only closing thought for the agents would be that as the natural disasters get worse and worse, it's very important to make a note of this and go through the disclosures with the sellers to make sure that these things are being disclosed, and with buyers to make sure they go in with their eyes open and are asking questions, because in our market, as the market goes up, people become too complacent, making offers non-contingent over asking price, and then they buy houses at their max. And then when problems develop, they don't necessarily have options to fix things.
Mm-hmm.
And get a clue report.
I think Anthony and Marilyn have done a really nice, thorough job here. And I think you guys should retain their information. They're a very good resource. And, Marilyn's point is that if you plan ahead, you're going to avoid a tremendous amount of heartache and hardship. So the 5 Ps, prior planning prevents poor performance. I do believe in it. And especially now with homes being at such high values, there is a significant amount at stake at this point in time.
And we actually, Marilyn, before you wrap up, I just got a question that is very interesting. And maybe I should have had a lender on here now that I read this question. But is there a statute or something that tells loan officers that insurance companies insure the home, not the loan? Or can a home loan be affected by whether or not it's insurable or not?
I know I have seen lenders that want the insurance to reflect what the loan amount will be. And so there's a process of education that goes to them about how insurance is about reconstructing the home, not the loan amount, not the market value of the home. And so many home buyers are using the insurance that the lender recommended, or the real estate agent, and the referrals are great, but make sure that you as a buyer have a conversation with that agent. Just don't take it for granted. I hear so many people say, I don't know, I got the insurance through my escrow. So they don't even know what's on their policy. If you're making this type of investment, do your research.
Can I jump in and make a suggestion here? I think everybody here in the meeting may either be a property owner or a condominium owner. Some of you may be tenants. And really the best way for you to be able to educate your clients is for you to go through the experience yourself on your own personal exposures, call your current carrier, walk through everything that we've talked about, and now you have a living, breathing experience and can talk to those points, I think, more thoroughly.
That's a great suggestion. Yeah. Well, thank you everyone for being here, Tony, Birch, and Marilyn.